It's very clear that the central banks around the world are again easing. In other words, they haven't tightened all that much, because had the money become very tight, we'd be in a recession. We would have very low inflation or negative rates of price increases. But this is not the case. Inflationary pressures are still there, and investors are realizing there are huge problems, in the sense that, say, we have in America 2 presidential candidates. One is plainly dumb, and the other one is also, like the first one, a big spender. They have no intention to cut the deficits at all, to cut the debt at all. They both will add, with different programs, to the credit growth of government in the United States. And the US is not alone. Other countries do the same. And so we will move one day into some sort of a financial crisis. Whether it happens tomorrow or in 3 years, who knows? Because you can postpone with printing money for a long time. But I think more and more, especially wealthy people, realize they want to have something of their assets in an asset that is relatively safe. I'm not saying it's 100% safe, because if governments could lock you in under the pretext of COVID, they can also take your assets away. And the first one to take away would be, say, real estate, because that's obvious to anyone. And it can be done in a very elegant way, in the sense that you just increase taxation on real estate until most people can't afford to live in their own homes anymore. So I think that gold is kind of a safe haven. As you know, different countries have different property rights. Say in Switzerland and in Singapore, property rights are very strong. So to take it away from you in these countries would be quite something. Also in Thailand, I have to assume that, say, the king has some gold, so he's not very likely to want to take it from other people, because he would have to tender it himself. So all I'm saying is some countries are more likely to protect the ownership of assets of its individuals, and other countries are less likely to do it. And say in the United States, Mr. Trump is more likely to protect property rights than the communists that might be elected. Well, they can increase taxation on homes. They've done that in the 19th century in Britain. So a lot of wealthy people at the aristocracy had to leave their homes, their castles, because they couldn't afford it anymore. The wheel's coming up. Maybe one of the wheels is already off. The economy is on 3 wheels. But the economists today, they are paid by Wall Street. And Wall Street is essentially in alliance with the Federal Reserve and so forth. I don't think they want to present the truth. The fact is simply the government debt requires increasing interest payments. In that sense, one wheel has come off, because over the last 18 months, the interest payments on the government debt have more than doubled at over $1 trillion a year. And it doesn't look as if interest rates will drop a lot unless we are in a recession. But at the present time, since the rate cuts occurred, the US Treasury market, long-term bonds, have been actually selling off. They haven't been rallying. So the bond market doesn't like these rate cuts, because the bond market knows that these rate cuts are inflationary. And the old economist, Irving Fisher, he wrote about the debt deflation theory. The problem is, as government debts become bigger and bigger, an increasing portion of the tax revenues, in other words, you and I, we pay tax. The government gets these tax monies that we pay, these government's receipts, and they have to pay the interest on the debt first. So the interest payments on the debt actually retard other programs of the government that might be, say, more desirable, say helping the poor in America, or doing something about the infrastructure, which is not particularly good in the United States. So over time, the debt payments become burdensome and hinder or make economic growth totally impossible. So then there comes the day when the government is actually forced to print money to pay the interest on the debt. And that is, in the process of accelerating inflation, a pillar that will make it clear and sure that the inflationary pressures actually accelerate. And when the inflationary pressures accelerate, the interest will go up and the debt payments will increase even more. My sense is that the US and other Western European countries, they are so far along in the process of fiscal deficits that there is no way out but to print money. There are ways out, but as a politician, if you go to your citizenship, then you tell them, look, we have to tighten our belts. What it means is you have to pay higher taxes. And you, the policeman and the fireman and everybody, we cut your nice pension by 30%. Do you think this politician will get elected? The politician will get elected who dismisses the whole debt problem and promises, oh, we'll cut tax here and we'll give you subsidies here and social benefits there and so forth and so on. All programs that lead automatically to higher inflation rates. In my view, the outlook is actually very negative, but it doesn't mean that because of that stocks go down. When you print money, stocks go up like now. Stocks are among the highest valuation on record, and yet people rush in and buy at these record valuations. If you print money in a marketplace, say you look at the US, I think the US is expensive relative to emerging markets and relative to Europe. But say in America, talking about expensive are the FANG and the Magnificent Seven stocks, and maybe the semiconductors. But if you look at oil stocks, they are depressed. There are some real estate companies that are depressed. And say staple companies have a relatively low valuation, but then there are stocks that have a very high valuation. So I'm not saying I would avoid stocks 100%, but what I'm suggesting is that we are more likely to be in the years between 1927, when Benjamin Strong at the Reserve Bank of New York, he cut the discount rate at the time, and that then propelled stocks even higher. We are somewhere between 1927 and 1929. We're not like between 1982 and 84 at the beginning of a 40-year bull market. That I want to make very clear. The valuations are very high, and the economic circumstances, if you look around the world, the global economy is lower than at the peak in 2018, 2019. There's been hardly any growth. Some sectors have been growing, but most sectors have been contracting. And in the meantime, stocks have gone to the roof. As an economist, the only tax that is a fair tax is a flat tax. Anything else has a social agenda and is not an economic matter, but a social matter. Purely on economics, a flat tax, ideally 15%, and in the Constitution it should be anchored that the government is not permitted to have a fiscal deficit. So that would lead to essentially a sound household and to a small government. Small governments are good for economic growth. Big governments are a disaster because you have all these employees in government. They never worked a day in their lives, but they go and tell the honest businessman and small businessman how to run his business. These are the bureaucrats. The tariffs will increase the price of most goods for American consumers, and it will sort of anchor inflation in the United States and not lower inflation in the US. It will also make American industry even less competitive. Tariffs protect, say, industries in a country, the industries that are not particularly competitive. And in economics, let's say, if I come to you and say, here are two apples, it's a locally manufactured apple, costs $10, and another apple costs $1, is from overseas and is of better quality. As a consumer, what apple do you prefer to buy? The US is not in a particularly good situation to negotiate with China because A, Chinese exports to emerging economies are larger than to the developed countries of the Western world. In other words, Europe and the US and Australia, New Zealand and Japan. So the exports to emerging economies are larger. Number two, you have to see that a lot of exports of China to the US are actually not Chinese exports. The exports by subsidiaries of, say, General Motors in China or other US multinationals, they produce in China, say shoes, and then they export them to the US. So you're hurting actually your own industries as well. Number three, China has some products that actually the US needs. It's not that China has no bargaining power in this matter. Rare earth materials, many products the US wouldn't be able to do without China. To some extent, they've done it already in the 1980s and 1990s. Without China, we wouldn't have had this disinflationary trend. But now they are doing it again in the manufacturing goods industry. There's no inflation in goods, but there's a lot of inflation in services. Like if I buy automobile parts in China, the price is maybe lower than a year ago or lower than 2 years ago, but the transportation cost to the US is up and the distribution cost in the US is up. So overall cost is up, but the part itself has been deflating. Not all products, but a lot of products. Look, I used to discuss this matter with media people at TV station in New York, and I told them, look, do you really believe that your rate of inflation, in other words, the cost of living increases in New York, is 2% per annum? I looked at them. All of them knew that their cost is going up like 7% per annum because rents went up, insurance premiums went up, but they denied it. They didn't want to tell the public. They were told by their bosses, don't provide bad news. Money has various functions. One is an accounting unit. I don't think it's a very suitable accounting unit if you can print it, you understand? But say gold is a better accounting unit. Now, they buy gold because they can have it delivered to their own country and put in a safe place in their central bank or in the Treasury Department or wherever they perceive it to be safe. We in Switzerland, we kept it in Bern. Then Napoleon conquered Switzerland. He took all the gold to France. So nothing is 100% safe. But the behavior of the US internationally and geopolitically has made many countries suspicious to hold all their foreign exchange reserves in the United States. If the US freezes the assets of even Afghanistan, what has Afghanistan done to the US? You know, it's one of the poorest countries in the world, and the US freezes their assets. They freeze the assets of Russia. Then India and China and Indonesia and all these countries, they say to themselves, do we really want to hold all our assets in the United States? And they come to the conclusion, no, we want to have something safe. So they buy gold. And they can also see the money printing that is going on in the US. They can also see government debt grows and the interest payments grows of the US government. And so they don't trust the US dollar anymore. Now, the US dollar has up to now been relatively strong, and it may continue for a while. But I can tell you one thing, if the US dollar keeps on strengthening, what can be done is a bad intervention. Like every intervention is bad, but it can be done, and some countries have done it. They create a dual currency, one for financial transactions and one for trade transactions. Central banks are a very evil group of people. They lie to the public about many things, including the true rate of cost of living increases, which is much higher than 2% or 3% per annum. Believe me, much higher.